progress and look at what we have today. And today we are looking at cost of capital. So how has it been so far? All right, so we're going to connect now. Since yesterday we looked at capital budgeting, now we'll look at another important element of corporate finance, being cost of capital. Maybe what's anytime we hear the word cost of capital, what do you think comes to your mind? If you talk of cost of capital, what's your understanding of cost of capital? So, getting a premium that is charged for getting capital. Right, that's correct. So basically, cost of capital, we're looking at, just from the title itself, the cost that is involved in attaining capital. All right. So we pick it out from there and let's look at maybe what are some of the after studying the chapter, what should be the goal of this chapter? Maybe it's to have the introduction to what cost of capital is all about and try to answer this question, why is cost of capital important? I think in the first place, we can't be looking at something that is not important. Then again, we'll look at the three major components. Now, I must make mention that there are a lot of sources of funding for a company. Any project that a company wants to undertake, there are a lot of sources. And some, as business evolves, there will be other platforms that will be coming now that a company can use to source out funding. Just like we're talking about business innovation and finding how now business is evolving and the like. But maybe for the purpose of this course, we might look at the three major components. And every company, whether it being small or big, their goal is to be bigger than their size currently. And even as we saw, what's the major goal of any company is to maximize profits, isn't it? Now, how do the companies maximize profit is by acquiring more capital to finance their growth. And I think when we looked at capital budgeting, we came to the knowledge of the different reasons why companies get capital, additional capital. Is it for expansion? Is it buying new equipment? Is it replacing machinery? Now, all those reasons that validates capital budgeting, they come at a cost. Every company that, if today their goal is, come 2020, we have to be 2 times bigger than our current size, or our projected cash flows have to double. Basically, the company has to put up new investment. But those investments, they will come at a cost. Now, the three components, we'll look at the component of debt as one of the sources of finance in corporate finance. And we look at preferred shares, and we look at common equity. That is just interchangeably used for common shares. All right. Then we'll look at what we call the WACC, or basically the weighted average cost of capital. At this component, in this component, all we'll just focus is on average. Imagine from the three components, as a company, you decide that you're not only going to get capital from one source. In this case, you're not only going to get capital from debt, you're going to get capital from preferred shares, and also going to get capital from common equity. Now, the two is either you go to the secondary market where you already have shareholders and you sell, somebody wants to sell shares after maybe the price of the shares have gone up to acquire more capital, or you go to the primary market. The company decides they're going to issue out new shares. All right. If you look at debt, the company decides they're going to get a bank loan. Or the company decides, all right, they're going to look at maybe and get a bond, which is just simply a long-term loan. So, now the combination of all these three, on average, they are going to give us what we call the weighted average cost of capital, abbreviated as the WACC. Then, let's look at the introduction to cost of capital. Basically, we've defined what cost of capital is. In basic terms, we can say it's the cost that is incurred when financing a project. And since we are looking now at the aspect of, after knowing the three sources where the funding is going to come from for a project, we now move a step further and look at what's the cost. Remember yesterday we looked at, when we were looking at capital budgeting, we had to bring a distinction between financing decision and the financial management. Because we said certain project, as you are making a decision to, an investment decision, before you even go further into finance, you will come at a place where you realize that the project would demand a lot of money. The expenses are above even the capacity of the firm to use their already profits that the company is making. Now, in the cost of capital reflects the average cost of funds for the firm. Obviously, nobody wants to give away money in business. Nobody wants to give away money for free. Now, every financing for a project comes at a cost. Whether it's equity, the money that the company already has, like from its common shareholders, or whether it's from the banks, through debt, all those sources, it comes at a cost. Now, in other words, it is the return required by investors in the firm. If the shareholders in stocks, let's pick it for example, Copperbelt Energy, it's a listed company in the Lusaka Stock Exchange, isn't it? And it has got shareholders, preferred shareholders, and common shareholders. Now, we assume that Copperbelt Energy decides to put up a solar plant because they've seen the demand for electricity, both for their major customers being the mines, it has gone up. Okay, there are a lot of mines have expanded, so they're demanding a lot of electricity, power from Copperbelt Energy. And Copperbelt Energy say, okay, for us to meet the demand that is currently in the market, you've passed now the stage of capital budgeting. Okay, you've come up with a project, we're going to put up a solar plant. Where? All right, you decide somewhere along the Luangwa Valley, where there's too much sunlight. All right, then the board has approved. And now the question that remains is, where are we going to get the funding for this project? At this point, you are now brainstorming the three options. Of course, we've just stated from the beginning that there are other options that a company can use to source out funding. But in this case, okay, let's look at the major three, which of course, they are certain that, okay, if we don't go for debt, we go for preferred shares. If we don't go for preferred shares, we go for common equity. Then, at this stage, Copperbelt Energy begins now, okay, let's look at the side of debt. Which source, which bank is ready to give us the amount of money we need? All right. What if before even we go externally? But what about it internally? Can't we get money from our shareholders to finance this project? And obviously, every project is, we looked at that aspect of, it's as we're asking for additional funding. So the shareholders, okay, we're going to throw out new shares on the market and let the shareholders buy so that we can have so much money to finance this project. Or we look at, okay, which shareholders, okay, I think the preferred shareholders are able to give us this money. Okay. Then maybe you come at a point again, you realize, okay, the common shareholders is not good enough, the preferred shareholders is not good enough. Okay, let's now go outside maybe and source out for debt. All right, okay, we'll go where? Let's go to Barclays. They said that $10 million that we need, they're able to give us at least 30% of it. Now, you're now looking at what cost will Barclays be able to give CEC, Copper Belt Energy Corporation, 3 million US dollars. All right, because the rest you say, okay, you break it down amongst the shareholders. Okay, so cost of capital depends mostly on the assets, the use of funds, not the financing source of funds. So, if debt, if we are going to use the assets, you know, if you check on the balance sheet, stocks are assets, isn't it? So they fall on the side of the asset side of the balance sheet. So debt might be the last option that the company wants to incur, because they say, okay, we can source out funding internally. All right. So let's proceed. For example, we are saying that a firm can only have a positive NPV on a project if the return exceeds 12%. So, if 12%, maybe in this case, is the return that so we're connecting from capital budgeting, where we looked at NPV, and just a recap. NPV is where we look at the projected cash flows that we had, then we discount them because of the concept of that money loses value as time goes by. Now, and we've gotten a positive NPV, because a positive NPV entails that the project is viable for us to undertake. All right, so we pick it up. So the firm can only have a positive NPV on a project if the return exceeds 12%, which means if the returns are less than 12%, we're saying that the NPV will be negative. Therefore, the project is not viable. So the firm must earn 12% just to compensate investors for the use of their capital in a project. So the use of capital in a project must earn 12% or more. Not that it will necessarily cost 12% to borrow funds for the project. Thus, the cost of capital depends primarily on the use of funds and not the source of funds. All right, let's build up on that. Now, what's the importance of cost of capital? Number one, already we're linking capital budget decisions. Obviously, the board to give a go-ahead, they've seen the technicalities, all right? The financial analysts have already estimated what cash flows, the profitability of the business. But now it goes back to the board. If the cost is high, should the decision be made for us to undertake this investment? Now, the other important reason why cost of capital is essential is that for the purpose of designing the corporate financial structure. Now, the financial structure of a corporation entails, if we put up how much is going to come from preferred shares and how much is going to come from debt and how much is going to come from common equity, Of course, we're not overriding the truth that certain businesses, they're not into shares. But every business, there comes a point where it grows so big that they start using shares. Even the smallest business, if the business consists of 3 people who have injected money into the business, of course, they will decide what's the capital structure, financial structure. All right, maybe the other person put in 50%. Then the other remaining 50% was divided among the other remaining two individuals, owners of the company. So now, you're already talking about structure in terms of ownership, but now we go further now, designing corporate financial structure. What will be the composition? So we're going to look at this because it's going to play a very important role, how it helps us when we come up now with, on average, what could be the cost of capital that the corporation is going to incur. All right. The third importance element of cost of capital is that deciding about the method of financing. Okay, so are we going to go for debt? And obviously, the guiding factor there is, the first word there, even in our topic, is cost. Then again, you're going to see that from the 3 sources that we're going to look at today, you realize that there's some form of what we call the tax shield when it comes to debt. So companies would rather go for debt than use common equity because of the tax shield. So we're going to look at that and how that tax shield benefits the company. So one of the importance that when deciding about the method of financing, cost of capital will come and help the company now. All right, so where are we going to get, how it should be the method of financing the project? All right, the other aspect is what we call performance of top management. Obviously, if top management is able to maximize profits by minimizing cost, I think that is what we can call good performance, isn't it? Because the goal of the firm is to maximize profit. What's the goal of, what's the interest of the shareholders? They are wealthy, must be maximized. Whose responsibility is it? Top management, from the board to level operation management or the CEOs, that category. If they are going to be considered that they're really performing well, it's going to be also on the basis, how have they managed the cost of capital? How have they managed the cost involved in looking at a project that needs funding? All right. And of course, the last part, but not the least, is looking at the other areas, like, for example, dividend policy and working capital. So, there are certain decisions the firm will make, not necessarily that they need a new project to be implemented, but rather that they need more working capital. So already maybe they need, if they can inject more capital into the business, I think the operations of the business will be a bit eased, or it will bring some levels of efficiency in terms of production. And I think that comes from that element we mentioned, that we're not looking at a decision in terms of investment for us to replace or entirely to bring a new product into the market, but we're looking at the other aspect of, okay, let's just replace, maybe it's bringing up already new technology. So you're talking about, okay, I think for the work that a company is engaged currently, for it to be efficient, let's bring in at least new technology. But that technology is coming at a cost. But that technology is not basically a new project as per se, but it comes at an expense that can be categorized under working capital. All right. Having established the cost, let's look at what's next. Now, we'll look at the value of a firm, maybe using a pie, so that we answer that, we link that important element that we stated, the capital financial structure of a firm. All right, so the value of the firm. The goal of the manager is to increase the size of the pie. Now, let's assume the pie is our capital structure, which is a representation of the size of the company. So if a company is listed on the Lusaka Stock Exchange, in this case, whether it's Zambuf, whether it's CEC, whether it's Zanaco, of course, for us to know the size of the company, it goes with the price of the shares. But, so the smaller the size of the shares, the price of the shares, the smaller the pie, the size of the company. All right, and the goal of the managers is, of course, to maximize profits. How are they going to maximize profits? Of course, if a company is into production, like maybe National Milling, or it's a mine producing copper, if copper production goes up in terms of the tons that the company is able to produce per year, would have said that, okay, the managers have managed to increase the size of the pie. Now, let's look at how this pie will look like. So the capital structure decision can be viewed as how best to slice up the pie. So now we're looking at, debt, equity, and preferred shares. But how do we slice this capital structure? So we're using the example of a pie. Okay? So, let's assume the first component we decide we're going to go for 50% debt. And of course here, there might be reasons. Maybe we're looking at, okay, Bank of Zambia have just slashed interest rates, the monetary policy rate. So relatively, we're just saying that the cost of borrowing money from the banks has become cheaper. That could be the reason. Okay? Or we can look at currently, if we do our fundamental analysis about the economy seems to be doing much fine. That's an example. The economy seems to be doing much fine in Zambia, that there's too much money the banks they're having. Therefore, they're offering low interest rates, which is very attractive for a company to go for such. Okay? Maybe that's why it has taken a bigger share, 50%. Okay, let's look at what other decision the firm makes. Okay, in this case, we say, okay, we are not going to tamper with our preferred shareholders. Let's go for equity. And obviously, we're looking at common stock holders that, under common stock, we'll look at this when we come and look at stock valuation, because it's an important element that will make much sense. Especially that we're looking at a lot of businesses in Zambia are slowly also gravitating as the economy grows, as there is a lot of efficiency in the financial market. We also see the performance of companies on the Lusaka Stock Exchange really becoming also efficient. We're not saying companies are not efficient, but we're saying the performance of the stock exchange. And that goes with the volatility of the prices, which means companies are not growing as much as they're expected to grow. Because if there's a growth rate of maybe 10% on average for a company on the Lusaka Stock Exchange, then we are saying that every year we expect the price of those stocks to be growing by that much, isn't it? Now, so maybe common stocks here, we're saying, okay, as a company, as a firm, as a business, and I must make mention here that, a lot of African business, I was looking at how easy it is to offer an IPO or initial public offer. If maybe my company, let's take it for example, if my company market capitalization or valuation of the company has gone maybe to about, for argument's sake, 30 million kwacha, which is in dollars, that can be how much? 14 to 30, that's about almost $2 million, huh? Yeah, round off, just about that much, it's just an estimation. So we're saying my company is now worth $2 million. Okay. Now, if I put up a share price. So let me use the quatters to bring it just home. If we're saying $30 million is the value of the company, and let's assume, okay, I've entered into mining. All right. So if my company valuation is $30 million US, and I decide we're going to offer 3 million shares, okay? Maybe 3 million might be too little because I'm looking at the, okay, 30, maybe about, okay, for argument's sake, 30 million shares, which means, okay, I've offered to the public that per share is going to be 1 quarter. Is it? Per share is going to be 1 quarter. But if we decide maybe to put the shares maybe at 2 quarter, then we're saying 2 quarter into 30 million to give us about 15 million, isn't it? Now 15 million, we'll say, okay, we've offered 15 million shares. So we are just basically saying the quarter, the 2 quarter represent the price of the share, but the 15 million represent the actual number of shares. All right. So I'm saying, maybe I'm just trying to assume this is my company. And I've decided why I've decided for equity. I think I've explained why maybe I've decided for debt. Now, let me bring my reasoning why I've decided for equity. Maybe I've seen that it's very easy for me to raise money. If I go for preferred shareholders, it can be very difficult. Because preferred shareholders, they want to be attracted by how much dividends the company will be paying. Such kind of reasons. But common stocks, they're just looking at capital gains. If my stocks are able to be bought, if I buy a stock now, then in the next 5 years, it should have grown by 15%. I sell my stock after 15% and I gain my profit. I don't care about dividends. So I know that there'll be bigger demand on common stocks than preferred stocks. Not that, because looking at also the scale, how many people are ready to buy into preferred shares. And again, why we can't offer preferred shares? Because preferred shares, just by the way itself, it gives certain preferences, maybe voting rights, certain decision making for the firm, the direction the firm needs to take, certain preferred shareholders, maybe they even sit in the board of directors. So that seat is like the topmost. So they don't want to give to anyone. But the company needs money. But they don't want controllership to be destroyed in terms of where the company is going. Of course, non-common stockholder goes to the company and said, okay, I'm voicing out now, this is where I want the company to go. But the preferred shareholder can influence the other shareholders and say, oh no, I think we need to change this policy. So, there are those kind of reasons. There could be a number of them depending the kind of operation the business is in. But, so, we'll go settle on for equity. All right, so I've said equity, 50% is going to come for equity. All right, so I decide to give an IPO. I take my company public on the Lusaka Stock Exchange. All right, and I've decided 50% of the money I need for the company to grow or to reach at a certain level will come from shares. And what do I do if I take my company public? But I know after taking my company public, I know that the project that I want the company to undertake, the 50% of taking it public won't be enough. But after taking it public, and now the banks are even enticed that the company has now grown to a certain level, so to be able to pay back the debt. All right. So then I go for 50%, get the money. So we're just just saying basically this is how the pie will look like. All right. Now, if you slice the pie, if you slice the pie, the size of the pie, then the capital structure decision matters. Okay, because here we are saying, what I'm just explaining here is the decision making in terms of the capital structure, because we're looking at now the technicalities, what is involved if as a company today we decide, okay, we're going to go for debt. What's the pros and cons behind that? If we go for equity, because there are reasons why people go for debt. Banks are only interested in one thing, give them back their money. They're not interested in running your company. But common stock holders, they've got a say in the company because they own the company. Every common stock every common shareholder owns the company. All right. So let's slice the pie, maybe, let's take now, 75%. And obviously, they might come, it comes with other reasons again. Why are we letting go? Maybe we would have reflected, no, debt has become expensive. Look at what currently our economy is performing. They have, the monetary policy, looking at also the fiscal policy, the government has put up contraction fiscal policy, basically saying that government has cut down spending, isn't it? Government has cut down spending in Zambia currently, and if government can't spend, which means already you are saying there's the circulation of money in the economy has reduced. Why? Government doesn't want to spend. Okay? So if that is a reflection, okay, what are we seeing for monetary policy? We're saying if monetary policy, the interest rates are still favorable, just for argument's sake, are still favorable for Zambia, okay, but it seems that it's still going to be expensive for us to pay back. Because if government has cut down expenditure, we're saying maybe the cost of production for us as a company is going to go up. So we don't need to go again in cut debt because it's going to be relatively expensive. All right, so let's slice the cake. Let's take 25% to equity. It's better we owe money to the owners of the company than owing money to other people. All right. Then you take it up. You can also decide to slice the cake or the pie in that direction where you say, okay, equity 70% to debt. Why? Because maybe you want to enjoy the tax shield. We're going to come to that, but what we mean by the tax shield. All right. Then we are saying the form of capital that a firm uses in financing its business makes what is known as its capital structure. So maybe even those that are watching online, they might be asking, okay, we've been talking about capital structure. It's basically the form of capital that a firm uses in financing its business is what we're calling in this case capital structure. So a company may use only one type of capital, say common stock. Or it may use a combination of the different capital sources. All right. Now, what sources of long-term capital do firms use? Okay? What sources of long-term capital do firms use? So long-term capital, it can be broken down into what we call long-term debt. Because if a company, like maybe CEC, KCM, the size of that company, they can even go into the Eurobond market. Of course, maybe $500 million. Wouldn't it be small for a company like CEC? I don't know. Maybe a company like Barrick Mine or First Quantum. Would be not that amount be small? Okay, I don't know. But all we are saying is that there's what we call the debt market, where you can be able to get debt. And even Bank of Zambia is able to give away bonds. So that's debt. If they're selling bonds, you go. If they're buying bonds, you can go sell a bond. Then the government get money to finance for the company. Then you pay back that bond that matures in the next 5 years. And because maybe it's Zambia, you're a Zambian company, of course maybe the interest rates may be favorable. All right. We'll be looking at also what are the other long-term capital sources. We're talking about preferred stocks. What are preferred stocks? These are stocks that offers preferences like dividends. It also offers a certain level of control to the shares over the company. Obviously, anyone who wants to be a shareholder wants to be a preferred stock. And when we come to stock valuation, we're going to see what are the advantages of being a preferred stockholder. Okay, but in this case, we're looking at, okay, the cost that is involved if we settle for preferred stocks. Then we've got common stocks. Then under common stock, we're talking about retained earnings and new common stock. Retained earnings are just basically saying already if somebody, the value of the stock goes up and somebody sells, the stock, another one buys. Those are retained earnings. But again, we can also say the company can decide to offer new common stock. Can decide to offer new shares on the market. That's new common stock. All right. Okay. Now, the first component. Let's zero in now and look at them in details. Cost of debt. What is debt? Debt is borrowing money from somebody. It's money. So debt is borrowed loan or capital provided by a lender who is a creditor in exchange for interest payment. Now, of course, those interest payments is what we are interested in now, because that's the cost. They say, what's the cost of money? Interest rate. It's the cost of money. Because money is an asset. There are people who are into selling money and buying money, isn't it? So, banks are into that business. What's the asset of the bank? Money. Of course, they've got other assets like properties, but what's the most traded asset that the bank has? It's money, cash. They give away cash, people pay back with interest, that interest becomes the cost. All right, so the interest paid on a debt at a given rate is the cost of debt capital. Right, so we're not looking at, because if as a company in Zambia you want to extend, okay, want to put up a new investment where? In the Copper Belt. All right, what do we need? We think we need 10 million kwacha. Okay, so what is the interest involved? Okay, if we pay back in the next 5 years, we're going to pay back 15 million kwacha. All right, okay, we'll go for it. That 5 million, when you subtract 10 from 15, we get the 5. That 5 million is actually what we call the cost. Now, that is monetary value, but in this case, we're looking at, now, what's the percentage of 5 million in the whole 15 million? That's what we're calling cost of debt in this case. All right. Since interest expense is deductible under tax rules. All right, okay. There's what we call tax evasion, and there's what we call tax avoidance. By law, tax avoidance is legal, isn't it? Tax evasion is illegal. Now, what do we mean by tax evasion? It's like somebody, you need to pay tax after you reduce all expenses from your income statement. You still decide to lie that actually our expenses were 10 million and yet your expenses were 5 million. So you've evading tax by 5 million, and that's illegal by law. But tax avoidance, a company can decide to borrow. Now, if they decide to borrow, what is the reflection of that borrowing on the financial statement? It becomes an expense, isn't it? Or that debt obligation is an expense, isn't it? Which means all the monies to be involved with taxes, with debt, is what we call now a tax shield. Now, the tax shield lowers the overall cost of debt. That becomes a reason why, if I'm in the position maybe of advising the company after doing the fundamental analysis, the technical analysis, and we come to a resolution, okay, we've got maybe options to go for debt. And I look at, okay, look, I present this to management and I tell management, if we go for debt, look at the advantage. Debt will give us a tax shield. And obviously, every budget in, budget out, there's always change in terms of regulation, isn't it? What if maybe they've increased the tax or that to be charged on cost of debt? Then it becomes favorable for us and say, okay, we're going to settle for that. All right. So the tax shield lowers the overall cost of debt, which is a benefit to the company. The cost of debt, in this case, maybe for the sake of the calculations in this class, we use KD. And let KD be the cost of debt before tax. when we take into account the tax shield, this changes. Okay. Let's look at now what happens. So, that just becomes our basic formula that we're going to use. The after-tax cost of debt, because we've already stated that the KD we are seeing in that formula stands for cost of debt before tax. Now, inside those brackets, we've got 1 minus T. Now, T there is a tax. Okay? Let's see if where T is the tax rate, KD is the cost of debt before tax. All right, let's look at an example. In this case, debt cost is 10% and the tax rate is 40%. Now, of course, when you're doing fundamental analysis as a company, remember we talked about being able to look at certain opportunities that have to do with what will be the trends for next year. What if, as a financial analyst, you're able to predict that in the next 1 year, I think the tax rate is going to go up, which is for the compound tax. And obviously, every tax regime, if you look at the bigger view of it, it favors the rich. Companies always cry out. Government is there to see if companies are happy, the economy will drive well, will be driven well. If companies are not happy, okay, KCM may decide, okay, we're closing down operations in Zambia. And we're looking at, oh, okay, who is funding our budget? All right, so company tax becomes now something that you can debate upon as a company or push agendas so that policymakers are able to favor the company operations. And this happens everywhere. It happens everywhere. Now, what is the cost? What is the after cost of debt? So from our formula, we know that KD, which is about 10% in that example, multiplied by, open bracket 1. Now, in this case, we are changing the percentage into decimals. So what we're saying, how we're getting the 0.4? The 0.4 is simply 40 divided by 100%, since it's a percentage. Then we get 0.4 there. Then when you subtract 0.4 from 1 to give us 0.6, isn't it? Multiply by 10 to give us that 6%. Now, the cost has been reduced from 10% to what? 6%. And this is the major advantage of using what? Debt for financing. Okay? So being put in a position where whether you are the owner of a company or being put in a position where you are just advising the company, you must be able to advise the company. So, okay, we're able to go, if we go for debt. So if we increase the capital structure and we allocate more to debt, then we know that the cost is going to be reduced. Why? Because, and this concept is what we call the tax shield. What's the tax shield? This is the incorporation of the tax that regulations put for every debt, because debt is considered as an expense. So you're given more of that, don't want to call it an exemption, more of a shield, that the end result of it is that it lowers the cost, entire cost of debt. So imagine you're supposed to pay 10%, but you end up paying. Now, how do I explain that? The question is, but who pays the tax? The bank, when making money, when making profit, they are taxed, isn't it? Now, the tax authorities, in this case in Zambia Revenue Authority, doesn't wait for you as a company to have the money. They come and tax you. The moment they are issuing all that debt, every payment of interest. So if you say, the question is where the 4% out of the 10% goes where? It goes to government. Okay? But who pays that? It's the bank. Right. So, let's continue. Let's look at another concept now. Cost of preferred stock. Now, we might be looking at these stocks and maybe somebody is planning to go into business or is in a corporation that is not really looking at stocks as per se. There's an acquiring of knowledge that helps you change the way you think about running an organization. Because basically, if an organization is a private company, okay, it still deals with preferred stocks, preferred shares. If it has grown to a level whereby everything has been formalized, because a company that has reached at a point where you're even able to document shares, okay, these are shareholders, okay, how many are there? They're 10, because it's a private company. Okay, there are 10 of them. All right. So every time you're able to tell your shareholders, okay, this is what we're planning to do. Can you be able to issue out more shares? If we issue out more shares, then you have more money. Now, the dividend that is paid is fixed and is a percentage of the what? The share price. E.g., 10% of the preferred shares, meaning your dividend is 10% of the price you paid for the share. Okay, so the example we got was 2%, 2 kwacha for 15 million shares for a company that maybe I would have listed on the Lusaka Stock Exchange. All right, so let's look at the price, the formula. KP just stands the cost of preferred shares. Okay? I think even this one, we can even calculate it. Huh? Imagine, you can calculate it. You don't even need a machine or a software to calculate this one. Imagine you know what the price of the share is. If I look at CEC right now, oh, okay, the price of shares for CEC maybe it's 6, kwacha 15, where? Then I own shares in CEC, maybe what? Maybe 3,000 shares. Right? So I multiply 3,000 shares. Now, maybe because it's preferred, maybe I'll be talking about, maybe I own about 1 million shares in CEC. So I'm talking about my shareholding in CEC about 6 million, 6.6 million 500,000 kwacha is what my value of the share. Now, if it's 6 at 6.5, I'm going to divide, and the preferred shares, dividends always announced, that this year the board will sit down, maybe the last quarter of the year, and decide to say, okay, this is how much the company is going to pay out dividend. At what percentage? Maybe in this case, 10%. So 10%, they pay out 10%. So what I'm going to do is I'm going to say, okay, the 10%, remember, the dividend is fixed and is a percent of the share price. So they do 10% against how much? 6.5. 6.5. So 10% of 6.5 is how much? Is it 0.65? About 0.65. So I'm talking about roughly about 6 ingwe. Now I multiply 6 ingwe by my 1 million shares. What do I get? Okay, so that it might be, it depends, maybe the calculations, but if I multiply the 0.6 against the 1 million, it will give you maybe about 600 something. 600 something kwacha. Yeah, so but imagine if maybe just for argument's sake, if imagine maybe that's the routine how they're going to calculate for dividends. Because dividends, there's a way how we calculate dividends. When you come to stock valuation, it's going to make much sense. But at least at this point, all we just want to know is how do we calculate the cost of preferred shares? Okay. So an example, a preferred stock pays a dividend of how much? 11.7 kwacha and sells for 100 kwacha. So what we are saying is the 100 kwacha is the what? The price of the preferred share. And the 11.7 is the dividend payment. Find the cost of the preferred equity. All right. So our formula, we're going to say KP divided DP. DP is our dividend payment being divided the price of the share. Okay, what do we get? 11.7 divided by 100, it will give us 11.7%. Now, 11.7% becomes the cost of preferred stock. Okay, if you compare it, what was our cost in debt? It was about 6%, isn't it? So obviously, preferred stock looks to be more expensive than debt. And what makes debt cheaper? The tax shield. Okay, that's the advantage debt has. Okay, we continue and let's look at the cost of equity. What's equity? Equity is capital supplied by ordinary shareholders. Ordinary shareholders. That's equity. Okay? These are what are called owners of the company. It's funny, huh? Owners of the company, but they're also owners of the company who are preferred. If a company goes into bankruptcy and they're doing liquidation for the company, of course, the investors will be given their monies first. Who are in this case the investors? The shareholders. Who are the first to be paid? The preferred shareholders. Then you begin looking at, okay, are there any debt obligation that the company has to pay? So now, despite them being the owners, they too require a return for the amount they have invested. Otherwise, there's no reason to invest. All right. Shareholders expected to gain from their investment in two ways. Through share prices called capital gains and dividends paid by the company. Now, I'll give you an example like Microsoft. Microsoft, ever since its inception, it has never paid out dividends. But still, people still buy shares into Microsoft. Maybe we're looking at the efficiency of maybe the New York Stock Exchange, it being listed, Microsoft where it's listed. But again, also looking at the growth of the company is very faster. The rate is it's having a very fast rate. So shares don't remain. In the next 3 years, we're talking about shares maybe even moving from $50 to maybe about $80. Maybe in the next just 4 years or 3 years, So, companies can decide to do that, not necessarily pay out. Okay, but that's another story. But in this case, we're just saying, okay, this is what equity is. It's just capital supplied by what? Ordinary shareholders. Who are ordinary shareholders? These are owners of the company. Despite being them owners, they require a rate of return on whatever investment they have made in the company. Now, let's look at this. The two components form the cost of equity, which can be computed using the following. Now, in this case, we've got the first one, which uses the company model. Basically, all we are looking at is KE there stands for cost of equity. Cost of equity, which is equal to RF talks of risk-free asset. Now, risk-free assets are assets like, for example, treasury bills. Assets that are not risky. Why are treasury bills not risky? In this case, no matter how much government gets broke, it still gets back on its feet and be able to honor its obligation, isn't it? The only thing government does is that it delays to pay, but it doesn't necessarily defaults. If they're defaulting on a loan, then all we are saying is that government has been delaying and the loan has been accumulating, especially these Eurobonds loans. Like we see when the companies offer debt relief, all we are saying is that, okay, the debt has become so big that even if they pay, it doesn't even help the owners in any way, because the longevity maybe it has taken, or the period has taken for government to keep that debt without servicing it properly. Okay, so now the ERM you're seeing there is the market rate. What are we saying? We're saying there's a rate that the market is offering for assets in relation to the risk-free asset. Then the beta there, what you're seeing there, the B, which looks like a B, but it's not really the B, stands for beta. It's just simply what we're calling a beta is a measure of risk. It's a measure of risk. So we're looking at also bringing that component of risk involved. Okay. Now, when you look at there's what we call the dividend growth model. Is the second formula that we use when calculating the cost of equity. Either of the two will still give you, the same answer. All right. This is the cost of equity using the dividend growth model. The K, of course, is cost of equity. Then now, here we will now use, companies are able to go to a level where they're able to calculate the growth rate, the growth rate of the company. Okay, let's pick any company. Zambif has been in operation maybe for the past more than 10 years. What has been the growth rate of Zambif? We're able to calculate, okay, this is the growth rate of the company. It's growing at this pace. So, okay, the G there we're seeing there in the second formula stands for growth rate. The P with the small zero there down there stands for the price. Now, this is the price for the common stock. In this case, the equity, common equity. Now, let's pick it up. Let's look at example 3. Suppose for a stock, the risk-free asset is 8%, expected market return is 14%, and the stock beta, which is the risk, maybe it's being measured as 0.7. Find the cost of this stock. So basically, when you do the mathematics there shown in the slide, it gives you 12.2%. Now, in relation to what we saw, we will realize that cost of equity is more expensive than the rest. The other one gave us about 11.7. Debt gave us about 6. Okay. Then if you use the growth model, it will give us 12%. Okay. Now, ensure that your multiple, when you're multiplying with 100%, the first combination of the equation to convert the decimal percentage. So I'm saying when you divide the dividend, divide by the price, it will give us a decimal, then multiply that by 100 before you add the growth. All right. So cost of retained earnings. So the cost of retained earnings is the same as the cost of equity. So remember that time we looked at the long-term equity. We just said, okay, under long-term stock, there's that aspect. All right. Let's pick it up. Now, let's look at what we call the weighted average cost of capital. In this case, we're saying on average, we've looked at all those components. Calculating cost of debt separate, calculating the cost of equity separate, and calculating the cost of preferred shares separate. Now, let's look at, on average, what would be the cost of capital. So now you're looking at, not only are you looking at only one component, but you want to try and combine all the 3 components. All right. Weighted average cost of capital is the average rate of return a company expects to compensate all its different investors. So weighted average cost of capital is the average rate of return a company expects to compensate all its different investors. Now, we've built it up slowly. We're looking at each and every component, how cost is. Cost for debt, cost for preferred shares, cost for common equity. Now, in this case, when a company with a given target capital structure uses different forms of capital in its capital structure, an average cost of capital will be computed. This is called the weighted average cost of capital. Now, you're going to see now how even in the pie aspect, we take it into percentages in terms of proportion. What's the proportion of debt into the whole total cost of capital? What's the proportion of cost of equity into the whole cost of capital? What's the proportion of preferred stock into the cost of equity? All right. Then we continue from there and say, let's look at the weighted average formula. Okay. Formula looks funny, but all you're seeing is that the WE you're seeing there, the WPS and the WD are the proportion. You know, if you look at the capital structure, if we're having 3 of them, we're saying, okay, if we pick debt, what's the percentage of debt in terms of the whole total capital? So we'll look at that and see what that will look like. Okay, so we're saying there, W is the weight, in short, the proportion of equity into the whole debt structure. in the whole cost of capital structure. Then again, we're having KE. KE now is our computation. It's the value of the actual cost of equity. Then we come to WPS, means the weight, the proportion of preferred shares it has from the whole total cost of capital. Then the KPS just stands for the capital of preferred shares. The KD, WD in this case stands for the proportion of debt into the whole total cost structure. Right. Then in the latter part, the KD, the 1 minus T, just basically exactly what we used when calculating the cost of debt. Right. So, continue and look at, let's look at an example. The capital structure for Company Z. Company Z can be any company in Zambia. Extracted from the balance sheet. Okay, now how do we tell you the balance sheet? The balance sheet will be able to give us a component showing us debt and showing us the preferred shares and showing us also the common shares in relation to their cost of capital. So now, we can go at our balance sheet, and in our balance sheet we can pick up that. And as you're seeing, the first column there shows us the capital structure. Then the amounts there, which are in millions of kwacha, shows us how much debt, the source of debt, if, like in this case, how much debt was, how much preferred stock was, and how much common stock was. All right. And we look at what was the weight. Now, if you look at that, the question is, how do we come up with the proportion? This proportion may not be there in the balance sheet. This proportion may not be there in the balance sheet. All right. So what do? We look at the proportion. We look at the proportion of each component in relation to total cost. So if you see there, we're having 3 million for debt, preferred stock we're having 1 million, then we're having common stock 6 million. Total is giving us 10 million. Now, how are we going to find the weight? We're just going to say, if it's for debt, we're going to say 3 million divided by 10 million is going to give us 0.3. Now, 0.3 as a percentage, we're going to give us rounding off to about 30%. If you get the 1 million, divide by 10 million, to giving us about 0.1. As a percentage, it's going to give us about 10%. That's the 10% we are seeing there. Then 6 million divide by 10 million is going to give us 0.6. As a percentage, 60%. Now, when you compute the all weights, they'll give us 100%. Now, if you go back to the formula that we had, you're going to see that we had our formula. Just to go back, you've seen the weights, which is the WE. That's where you're going to put, if it's the KE there, WE, we're going to look at what was the weight from the computation of the weight. So KE, which is common stock there, is giving us 6%. Now, the weights are the percentage of the firm that will be financed by each component. So if possible, always use the target weights for the percentage of the firm that will be financed within the various type of capital. Now, as a firm at the beginning of the year, obviously you would have already stated your goals that 50% has to come from debt, isn't it? Okay. So which means the moment you acquire debt, you acquire preferred stock, acquire source of funding from debt, preferred stock, and even common equity, you have reached at a point where the actual weights now that will be computed, reflected in the balance sheet, should be in line with what the company earlier on stated at the beginning of the maybe the financial year, that in this year, this project, we're going to get our source of funding. The source of funding is going to come from debt, preferred stock, and common stock. Now, if you look at this, all we're saying is that as a company, you must be able to align the goals that you stated in the first place in terms of the percentage of the weights, which means the proportion where the other funding is going to come from to finance the whole project. Now, the weights are the fractions of each financing source. in the company's target capital structure. So as a company, you would have already stated that at the beginning of the year. All right. So that this is going to be our capital structure. Now, let's look at an example. Suppose a company has the following cost form of capital. Now, you've gone to your balance sheet. Your balance sheet has given you the actual value that we're seeing there in the table from this capital structure for company Z. Now, and company Z in this case, we're saying, okay, company Z has got, now, if you're seeing the KD there, which is the 10%, that KD hasn't yet been adjusted to tax. No wonder in the information being given, you're looking at the company tax being at 40%. So, depending that tax is subject to change, and we get these changes usually in the budget. And already as being in a position to make decisions for the company, we must be able to flow with current information. Because how am I going to be able to advise a company to go for debt if I don't even know what the company tax is? And if I'm able to predict what the company tax for the next year is, I'll be able to advise the company appropriate and see what. So now, look at the calculations. So all we are saying is that, remember, if you go back to, if you look at the structure, we're having 0.6 multiplied by the cost of equity plus the weight for preferred shares, which is 0.1, multiplied by the cost of preferred shares, which is at 12% there. Then coming to debt, lastly, the 0.3. Now, remember, we're just converting the percentages. This is just mathematical calculation. So we're just converting the percentages from percentages into decimals for us to use them appropriate in the calculations. Then, if you compute, you end up having how much? 10.32%. Now, what are we saying? Advantages and limitations of the weighted average cost of capital as hurdle rate for project evaluation. Now, the main advantage of using WACC for evaluation of projects is that it's simplicity. So now, that tells us that there are other examples you can use. But in this case, even me who has started a company, maybe in the next 2 years, I can use WACC. Given an opportunity that my company has grown to a level whereby I'm able to gather a platform, okay, good shareholders, I'm able to source out money from debt. Now, the main limitation of using WACC is that it does not take into consideration the flotation costs. Now, we're going to look at what flotation costs are. For us to facilitate just getting money from a bank, imagine we don't have an account with Barclays. Of course, we have to open an account. But are we accounting for that money into the actual cost of debt? No. We haven't. Now, we'll look at those. Paperwork, all those meetings that you're negotiating, they come at a cost. All right. Now, we're saying the WACC, the weighted average cost of capital, does not take into consideration flotation cost for raising the marginal capital for new projects. Now, another problem that the weighted average cost of capital has, that it is based on an impractical assumption of the same capital mix, which is very difficult to maintain. Now, what we mean by capital mix is that, imagine, this one is based that come next year, you will still be using preferred stock, common equity and debt, which may not be the case. And I think we've stated the reasons why the company might shift in terms of decision and say, okay, they're going to use debt. So if you see the WACC, because it's limited to look at only those three components. And I think later on in the course of these lessons, we're going to look at another interesting component, which is called venture capital. We're just looking at venture capital because as a corporate manager, you must be able to understand that away from these three components, we can use venture capitalists to fund projects. All right. If we go even further, we can talk of private public-private partnership kind of arrangement. Imagine you have to build a certain plant, and all you need is maybe government to come in halfway, and as a company also enter halfway. And I think we've seen government is a shareholder in CEC, is a shareholder in almost all these mines. There's a certain percentage shareholding that government has. So for a mine, even as a private company, it becomes easy. Okay, if I want to make an investment in a project that I know that I can bring government on board, therefore, the other expense part, in this case, we are saying that work might not be able to cater for that. All right, so that's the part we're saying is only making an assumption that it will forever be fixed. What if in the long run, you get a venture capitalist? He's ready to fund you exactly what you need from debt. All right. So, what factors influence a company's weighted average cost of capital? Market conditions, number one. Okay? Interest rates have gone up, or interest rates are down. All right? Tax rates. So right now, looking at the current trend in our country, as a company, you must be able to predict what direction are the taxes taking, especially for company tax. Is there going to be a likelihood that, or rather the probability that the tax rates are going to go down or go up? So you must be able to look at that. And that will influence how you're going to settle for debt in terms of its proportion to the total cost of capital. All right. Interest rates, just look at the cost of borrowing, maybe even on debt, and the interest rates. Now, if we look at these market conditions, we must be able to link interest rates, how it reflects in terms of stocks. Because if interest rates go up, which means the cost of borrowing has gone up, and we are seeing investment might be difficult in the country, because investors like going to the banks. Like in this case, that's why we're having the component of debt. So investors like going to the banks to get money. But in this case, money has become expensive to get. Why? Because of interest rates. So even the proportion might be affected in terms of which percentage you're going to settle for. Now, the firm's capital structure and dividend policy. All right. Like I earlier mentioned, me as an investor will always be attracted, maybe if I have a lot of money, I'll always be attracted to invest into a company that pays dividends. So if their dividend policy like Microsoft, they don't pay dividends. People only gain from Microsoft when their shares go up, so they only gain using capital gains. Maybe I want to invest into Zambif. What's their dividend policy? So as Zambif management, it might be very difficult to source out money from preferred shareholders, because maybe preferred shareholders in that case, they are only interested if the company pays dividend policy. I'm using Zambif, maybe I don't know their dividend policy as for now, but I'm just giving an example that if Zambif decides that they're going to be paying dividends every year, obviously they stand a better chance getting funding from the preferred stockholders. All right. The firm's investment policy. Now, this goes back now to capital budgeting, because here the firm's investment policy speaks so much about how does the company decides what's their growth structure policy. All right. Are they planning to expand or not? What kind of investments do they engage in? Because me as a common stock buyer, or I want to buy shares, obviously I've got preferences. I don't just go to any company just because it's profitable. No. If I'm an expert stock buyer, I need to start studying a company, if I want to go into commodity businesses that are into commodity business, like in this case, maybe mines. So, okay, I won't be interested if Zanaco is selling off their shares and they need maybe extra funding to expand their operations. So I might not be interested. So investment policies speaks more of how does the company decide which kind of investment to undertake and how do they take that. Okay, if NAPSA today goes public and the investment policy, maybe they're just into housing, they're into housing. Maybe me, I'm into commercial property, so obviously I won't buy shares from NAPSA. Because the investment policy affects shareholders in terms of if they want to buy. Okay, all right. So firms with riskier projects generally have a higher WACC. So another complex element is that the riskier projects generally have a higher WACC because the cost. You remember the banks when they're deciding to lend money, shareholders, they come and negotiate for more returns, okay, for their monies, because the likelihood of losing other money is high. All right. Let's look at what flotation costs are. While raising new capital, a company incurs cost, which is paid as a fee to the investment bankers. Now, we don't really necessarily have investment bankers in Zambia, but okay, maybe the perfect example we can give is that, okay, we've got stockbrokers. All right, I want to buy shares in CEC, I want to buy shares in Zambif. All right. I can just go because I'm not a broker. So I can just go, okay, Zambif, I want to buy shares. They're brokers, they're agents, who are in between the buyers and the owners of the company. Now, that whole process, it's a cost on its own. Like for example, okay, I want to buy treasury bills or bonds from Bank of Zambia. Obviously, you don't just go with exactly money. You know this. Imagine if there's an application form, it goes maybe 20,000 kwacha. It comes at a fee, but when you're factoring out that into the cost of capital, we don't include it, isn't it? Now imagine as a company, when you're formulating the balance sheet and or the income statement, you have to show the cost. That 20,000 moved from the accounting department to pay for the facilitation of acquiring of a bond or borrowing from the bank. Imagine you're a preferred banker. So you want to get a loan. They tell you, okay, for Zanaco, I think for you to open such kind of investment where we can be able to give you a loan, it will come at a cost of 2,000 kwacha. Every company wants to document those costs. But those costs are not included in the actual cost of borrowing or whether it's preferred stock. Now, selling issues to the public, we're talking about the stockbrokers. That's the job of stockbrokers. They find who should buy stocks. Printing the certificates. It's a cost. Whether the certificate costs 5 kwacha, it's a cost. If you go back into the company books, it has to reflect into operation expenses. Okay. Paying the underwriters, in this case, we're talking about this same guy, stockbrokers, to guarantee or as to help us to guarantee the issue of security in a specified price by entering into a purchase and sale agreement to bring securities to the market. Now, there are also what we call government fees. Of course, an investment, there'll be other fees that will be associated with the project facilitation and the like. So all these costs is what we call flotation costs. Now, we said the weakness of the work doesn't include these costs. But in normal operations on the groundwork, we can't overlook these costs. Depending what kind of source you want to engage in, just to pay the brokers, it's very costly. Now, flotation costs and the work. Flotation costs depend on the firm's risk and the type of capital being raised, like I mentioned. And flotation costs are highest for common stock, equity. Of course, because of the brokers. Now, further on, however, since most firms issue equity infrequently, the project cost is fairly small. Okay? Now, we said common stock, not every time you're seeing companies offering new shares. It takes time. We frequently ignore flotation costs when calculating the work. So that becomes a weakness. And you know, as a financial analyst who is consistently dealing with income statements for your decision making, you can't overlook such. Because there have to be a reflection in the income statement. All right. So conclusion on the work. Since the work is the weighted average cost of equity plus the cost of debt, we can say the weighted average cost by changing the mix of debt and equity. So look, if the cost of debt is less than the cost of equity, we can reduce the work by increasing the percentage of debt in the mix and vice versa. And we saw that the larger the debt proportion, the less costly the project, the cost becomes, because of the tax shield and the value of the firm, its earnings potential is maximized when the work is minimized. All right. So we look at now, what's the goal of the firm to maximize profits? How can they maximize profits? By minimizing the costs. So what's the goal of the managers? To make sure the weighted average cost is as minimized as possible. A firm with a lower cost of capital can more easily return profits to its owners. Remember, you are asking creditors to give you money. So the banks need their money. You promised them you're going to pay them back in 5 years. So you must be able to minimize the cost for you to manage the cost. All right. So the optimal or target capital structure is the structure with the lowest possible weighted average cost. Obviously, nobody wants to put up a target that they know it is going to be very costly for the company. Interest rates tax shield, deductibility of the corporate interest is critical. Therefore, because it effectively lowers the cost of debt. So like we saw, the cost of debt. All right. And therefore, many firms use the financial leverage. And I think every biggest investment, every bigger investor settles for debt because it offers that leverage. It lowers the cost. All right. So this is just, in conclusion, this is just, for example, I just picked some companies in the US. Okay. Maybe because of the availability of information for these companies. We're seeing General Electric has got the highest weighted average cost of capital. We're also having Coca-Cola there, Walmart there, and the lowest being Bell South. So at this point, we come to the end of the class. Alright, so at this point, you must be ready to give direction to the company about what cost, the total cost of financing any project, and the advantages and the disadvantages involved. All right. Any questions? It's clear. All right. So we'll pick it up tomorrow from where we've left today and look at other interesting components of corporate finance. Thank you very much. We'll see you tomorrow.